This morning on the Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us in studio this morning on this morning's Ag Issues program. Roger, good morning.
Good morning, Greg. Good to be with you.
Good to be with you as well. And let's get right to it. First off, this is part of the One Big Beautiful Bill Act that makes enhancements, significant enhancements, as a matter of fact, to the federal crop insurance provisions for beginning farmers and ranchers. But there are some things in this, though, as well, that need to have some close scrutiny if you're just getting into the business as well.
Yeah, there's one thing I want to focus on this one, and it has to do with a regulation from the Risk Management Agency in terms of the impact it's going to have when we do estate planning, transition planning, succession planning from a younger farmer from an older farmer to a younger farmer, and I'll explain that in a second. But what the One Big Beautiful Bill Act did in terms of the changes in strengthening crop insurance is it expanded the definition of a beginning farmer or rancher from an individual who's not actively operated or managed a farm or ranch for more than 5 crop years to one that has not done so for more than 10 crop years. So you can be a beginning farmer longer and qualify for the benefits that a beginning farmer receives under the crop insurance program much longer. And so that's going to allow more newer producers to qualify for these additional benefits. Now, if you are a beginning farmer or rancher, and I'll go through what that definition is in a moment, you get an additional 10 percentage points of premium subsidy on your buy-up policies. That was already there. And what the One Big Beautiful Bill Act did was give you a higher tiered additional subsidy for the first 4 years. So in years 1 and 2, you add another 5 percentage points on. So now the total additional premium subsidy in terms of what you don't have to pay, what is being subsidized by taxpayers, is 15 percentage points. Year 3, you get an additional 3, so that's going to give you 13. Year 4 is 1, so it's 11. And the years 5 through 10, it stays the same. So you get an additional 10% additional premium subsidy as a beginning farmer or rancher. So that is in addition to your base premium subsidy that all producers receive. So that's going to make the premium subsidy significantly less in the first couple of years. And then, of course, the One Big Beautiful Bill Act didn't change the existing benefits that are already there in terms of waiver of administrative fees and being able to use another person's production history as a beginning farmer or rancher. Now, those provisions are nice. One thing I'm not sure that Congress knew about when they strengthened the crop insurance provisions is how these rules work when you farm in an entity. And we have a lot of farming operations that are structured in an entity from an estate planning standpoint, from a tax planning standpoint, from a transition planning standpoint. And what the rule here is if you have an entity and anybody that has 10% or more of an interest in that entity, they must also be a beginning farmer or rancher. They have to meet the requirements. And so if son is farming along or daughter's farming along with mom or dad, then what's going to happen here is mom and dad aren't going to meet the requirement. If they've been a farmer for some time, they would also have to be a beginning farmer, but that's usually not the case. And so that means the entity itself, the farming entity, is not deemed to be a beginning farmer or rancher, so you don't qualify for any of these additional benefits. So that will have implications from an estate planning standpoint for us, Greg.
Yeah, because, well, the majority of the operations, entities in this case, yeah, it's son, daughter, and it's not like son and daughter or multiple children saying, well, we'll just form our own entity to be able to do that too.
Yeah, we try to slowly transition the operation from the older generation to the younger generation. Well, this rule really is going to come into play in that situation. It will force families, I think, to carefully structure ownership to ensure that only individuals that meet the definition of a beginning farmer or rancher hold a substantial beneficial interest in the entity, that 10% threshold. You're going to have to do that. So our traditional estate planning tools that grant ownership to multiple family members, maybe trusts, partnerships, including non-farm or experienced farming heirs, may cause the entity to lose eligibility for the beginning farmer rancher program benefits and those subsidies. And that might potentially undermine the financial viability of transferring the operation to the next generation. So we're going to have to create structures that satisfy both the family's desire for being fair and equitable distribution and the RMA's strict eligibility requirements. And so it's just another layering of planning that we have to worry about as estate planning attorneys and tax planning people.
So does this run kind of counter to what normal, whatever that means, congressional policy would be on that as well?
Well, it could. If the RMA's position on what a beginning farmer rancher is in an entity is counter to congressional policy of expanding crop insurance subsidies to beginning farmers and ranchers, which was pretty apparent in the One Big Beautiful Bill Act, possibly Congress will either provide a statutory fix in some type of late year-end bill or direct the RMA to write a less restrictive rule. But we first have to draw the Congress's attention to this problem.
Another thing that they can find on or another topic they can find on your Substack, this talks about the new installment payment election provision of IRC Section 1062 that starts for the taxpayer January 1 of 2026 because of the One Big Beautiful Bill Act. The provision applies to sales occurring in a tax year but beginning after July 4th of this year.
Yeah, the reason I say that that's 2026 is because if I'm on the calendar tax year, then my first tax year that begins after July 4 of 2025 would be starting January 1, 2026. And I'm the original drafter of this provision, Greg. It was Senator McConnell's office out of Kentucky that called me with an idea that they had. And they said, well, the senator would like to have a provision where a farmer can sell farmland to another farmer and not pay capital gains tax. And they wanted a rule in there that said that the buyer had to continue to farm it for 10 years. And I talked to the young lady that called me, his staffer, and I said, well, I don't have to reinvent the wheel on this one because we have a whole set of rules under Section 2032A of the Code, special use valuation. This got a 10-year recapture provision in it. It defines what a farmer is, defines what a farming operation is. So I can just bring a lot of those rules over and dovetail this new provision right into that one. Well, it didn't come out like originally drafted. I spent quite a bit of time, about a half a day, writing this thing, sent it in, and then didn't hear anything for a couple of weeks. And we're getting close to July 1st, and I know the administration wanted this bill on the president's desk by July 4th so he could sign it. So I called the senator's office back, and they said, well, the initial version got scored. It was going to be too costly, so we changed it. And they sent the revision to me, and there wasn't very much from what I originally drafted that got carried over into this final provision, other than the definition of what a farming operation is. They retained the 2032A definition of that. But if you sell qualified farmland to a qualified farmer and they're going to farm it for 10 years, then what you can do now as the seller is spread the net tax liability generated by that sale over 4 years. It's not really an installment sale. I kind of call it that. We think of that. But an installment sale, Greg, if I were to sell you farmland on an installment basis, then I would report an income, what I receive each year. Here, I get everything up front. And then I only have to pay tax on the net tax liability in fourths, basically. I take a fourth of that the first year and then a fourth the second year, so forth and so on. So it's a cash flow issue. I get all my money up front, and then I'm spreading the tax liability out over 4 years. Now, a question that came up recently, and it has to do with this tax year issue. A lot of farmers, Greg, are going to be on the calendar tax year, so January 1 to December 31. This doesn't take effect until my first tax year beginning after July 4, 2025. So I've received several questions as to whether, from farmers, as to whether they could sell land this fall and qualify for this provision. Well, to do that, you're going to have to change your tax year. And if you change your tax year to, say something like, let's say October 1, we move the tax year to that. Can I do that? Well, if I change my tax year to beginning October 1, the fiscal year beginning this year would be a tax year that begins after July 4. Now, that's a change in accounting period. And let's say the sale closes in November. So that would cause technically the tax year, the sale to fall into a tax year that's covered by the new law's effective date. However, I'm going to have to get IRS approval to do that. I'm going to have to file a form, what we call 1128, get the approval, and the IRS is pretty explicit in its rules. It says that you have to have a good business reason for changing your tax year. Just simply wanting to take advantage of a new tax provision is not going to cut it. So it's going to be very difficult unless you've got good business reasons to match up with your business practices, for example. It's going to be very difficult to pull that off and use the provision this fall. That's the bottom line of what I'm saying.
I was going to say good business reasons, according to the IRS, that wouldn't cover a wide variety of topics, I guess maybe is the better way to put it, as far as what would fall under those guidelines.
Yeah, the only thing that I wrote in my piece that might save you is if you've got a natural cycle for your farming operation that, say, ends September 30th or ends at the end of October, maybe you could do it. But if you've got a practice of not having that as your tax year for many years and now all of a sudden you change it, you still are going to have a really tough time convincing IRS that you've got a legitimate business reason other than just trying to take advantage of this rule. Otherwise, wait till January 1, sell the property to another farmer, and they need to farm it for 10 years. And there has to be a restrictive covenant on the deed, too. I won't get into that, but that's another issue that's out there.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us on the program this morning. And Roger, if people heard your agricultural law and tax report this morning, talking about the IRS moving towards electronic disbursements and also payments as well, and that's eventually going to be the norm here in the very, very near future.
That's right, Greg. This ties back to an executive order that President Trump signed in March of this year, and this is a move that's really stimulated because of issues with respect to problems that they've had in terms of theft, in terms of other issues associated with paper checks. And so they're trying to crack down on that. And what the order is that starting with the government's new fiscal year, which is going to be Wednesday of this week, so tomorrow is the last day of the current system, and then the all federal agencies shift to the new system, and that's going to mean I'm focusing on the IRS. And the order is that you deal in electronic payments. So disbursements starting on Wednesday will be electronically. There won't be any more checks coming out from the government. At least that's the way this is supposed to work. So they're modernizing their payments. They're reducing costs. They're trying to increase security and hopefully speed up the process and eliminate the possibility that paper checks would be lost, stolen, or altered compared to electronic payments. Now, that's well enough said, but we know that electronic systems can be hacked. We know there are problems with electronic systems. We know there are problems with air conditioning in this building. But that the disbursement side of this will change immediately. Now, I've had a number of questions on the payment side of things. That's going to take a little bit longer time to fully transition into payments made by individuals to the government to switch to all electronic. And there are waivers, there are exceptions, and that's an important one for agriculture because, and for lower income people. Greg, we have people in what's known as the VITA program, the Volunteer Income Tax Assistance Program, that are very low income, and many of them do not have bank accounts. And so if you don't have a bank account, you can't get a direct deposit. And they operate off of preloaded debit cards or cards. In general, they're not really a credit card; it's a debit card, and the government can charge those cards or take money from those. That's a little bit different, but if you don't have a bank account, this is going to be problematic. If you don't have access to high-speed internet, it can be an issue. So we've got some in really remote areas. You get out in Montana, Wyoming, not so much in Kansas, but some of the remote areas. It's going to take some time to work through probably some of the bugs in the system with respect to that. But the point is, Wednesday, the government's moving to all electronic disbursements. Payments to the government's going to take a little bit longer.
Yeah, I was just going to, the high-speed internet issue, there's still enough areas, I won't say it's definitely improved, but there's still enough areas that I won't say that's always being an issue, but still is an issue in this case.
It is. It is. And there are certain areas where when I travel, I've got to use a hotspot because I can't get an internet connection in some of the places that I go. But we'll see how this works out. I just want people to be aware of this. Now, the IRS, back on the tax side of things, they are encouraging taxpayers to use direct deposit and provide routing and account numbers on their tax returns. And then if you have a business, you can use the electronic federal tax payment system. And now that's where you can schedule various types of future payments. Maybe I'm making quarterly estimates. I'm making payroll type payments. That can work. Now, there is something out there that seems to indicate that program may be terminated in a year and they're going to shift to something else. We'll see what happens with respect to that. And direct pay from bank accounts can also be utilized, as well as electronic funds withdrawal when you're e-filing, and debit and credit card payments can be used through authorized processors and digital wallets. So there are new types of payment forms that are out there. People, if you're not using them, are going to have to start getting used to that. I talked about this on RFD TV last week, and you may know Suzanne Alexander, who was interviewing me. She was asking me about this, and I reminded her. I said, well, I'm a little bit hesitant concerning some of these things. I have never used an ATM machine in my life, so I write checks. I pay in cash often, and so this is kind of a new world for me. I don't deal with it. My wife handles all of these types of things, but this is going to be, for our ag people, it's going to be a change for some.
And that's something too, like many other things that we know. Even today, we discussed, talk with your tax preparer,
right,
and even your banker, I guess in this case as well, just to make sure that you've got all your ducks in a row.
Yeah, you don't want to miss something, particularly a refund coming back to you. That would be a key point.
Yeah, absolutely. All right. Roger, as we mentioned, some of these things are on your Substack, but if people want more information or like to read a little further into this, go to your Substack and or website.
Yes, a couple of these are also on website. Now, my website, the original platform was down. It's now back up, and we're linking that back through Walter, which is Washburn Agricultural Law and Tax Report. That should be done today. And a couple of these also are over at Ag Manager, and they're on the RFD TV, my blog on RFD TV.
All right, sounds good. Roger, as always, appreciate it. Thanks.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.